Hello and welcome back to Geneva and the Global Commodities Forum here at the United Nations. I'm joined now by Javier Blas, our Commodities editor. Javier, we've hit $100 a barrel for oil, and you've been speaking to lots of traders and commodity officials here. What's the general sentiment like?
Well, it's a very bullish sentiment in general for all commodities, but particularly for crude oil, because demand continues to be very strong. I will say that the general consensus here in Geneva is that demand is stronger than expected, and that the global recovery is gaining momentum, particularly in Asia. Obviously, the talk here in Geneva has been not on the conference, but here on the corridors, in the bars, in the lobby, because what is happening in the Middle East is adding momentum to the price of oil, and that's just pushing prices even higher.
Now, one of the traders you've spoken to here is Pierre Laurenay, who's one of the senior executives of Trafigura, the world's third largest oil trading house. He makes the point that high prices that we're having at the moment are actually caused much more by fear than any actual disruption to supply.
I think like everything, oil has become a bit of an asset class, and so there is more of an anticipation and a reaction to news, effectively, or to headline. I think the current price is more a reflection of what's going on in the in the Arab world and the instability that's being created by Tunisia and Egypt than an immediate issue on supply and demand concerns.
So Javier, what do you think affects in the Middle East and Egypt in particular? How big an effect do we think this is having on the price?
Well, it's adding some dollars to the price, but you have to remember that Brent prices that they have gone above $100 now. They were already very high. They were trading between $95 and $97 before all the trouble started in Egypt, so and the broader Middle East. So in reality, what is driving the price is a very strong combination of supply and demand fundamentals. The demand is rolling ahead. Last year we have a big increase in consumption. It was the second largest increase in consumption in 30 years. This year, what I'm hearing here in Geneva is that the demand is going to be also surprising to the upside. And meanwhile, the supply, well, it's growing, but the perception is that the supply is not growing at the same pace that the demand, so that's just tightening the market, and probably at some point it's going to force OPEC to start to think about a production increase probably in the next 6 months.
Now, speaking of OPEC, you tracked down perhaps one of the most influential figures in the cartel, Saudi Oil Minister Ali Naimi. He was particularly stubborn about price stability.
It is balanced today. It's very well balanced today.
And you think that in the near term, in the next 6 months, you need?
I don't conjecture. No conjectures. I spoke about it today, and I said it is fairly well balanced. That's it. Thank you very much.
So Javier, what exactly does he mean there by fairly well balanced?
Well, he chose the word very, very, very carefully, because Saudi Arabia and OPEC in general have been talking in the past that the market was very well balanced, even oversupply. Naimi is shifting the balance of the market. He's talking just to fairly balanced, and he's also putting it just over the short term. So he's acknowledging that the market is slowly but surely tightening. Saudi Arabia has already been increasing production. There's going to be a meeting in Riyadh on the 22nd of February of different oil ministers, but everyone from OPEC is going to be there. So we can expect some discussions happening there. But also I think that Saudi Arabia is sending the message that whatever they do in February, next movement by OPEC will be an increase in production. Maybe it's not coming next month, but surely over the next 6 months, OPEC is going to be increasing production.
Now, you said that most of the traders you've spoken to here at the conference have been fairly bullish on oil. Perhaps none more so than Marco Dunan, who's chief executive of Mercuria, another one of the world's largest energy trading houses here in Geneva.
Our target has been anywhere between $20 and $130 a barrel, with risk on the upside of blowing out of that upside if there was a crisis, say, in Iran, or a major crisis with supplying countries.
So you basically are saying that we have to get used to $100 oil?
Correct. This is a sort of necessary evil in order to kind of create alternative energy, to create new technology, to create energy savings, and therefore we need to stay in a high price environment.
So Javier, does this really reflect the views you've been hearing? I mean, is this the new state of play?
Well, I think that Marco Dunan probably is one of the most bullish traders right now on oil prices, talking about $100 to $120. But for sure, in this conference here in Geneva, there is a very bullish sentiment. There is disagreement about exactly what the price of oil is going to be. Some people think that it's going to be $75 to $80. Some they think that it's going to be around $100. Some of them, they think that it's going to go to $120. 120. But for sure there is a consensus that prices are going to stay very high. And probably the lowest figure I have heard in this conference has been for the annual price of oil in 2011 at $80. That may be not a record high, but it's a very high price. And that what is signaling is that the consensus here is that the era of high prices is here to stay.
Well, plenty more to hear from yourself and from the conference, and you can get more analysis on this story, of course, on ft.com.